Hey guys, I'm Kerwin.
And I'm Kenneth.
We are the Donis brothers. Jeffrey is busy today, so it's just Kenneth and I. But today we are talking about identifying a good market to invest in. Kenneth is the acquisitions guy on our team, and so he knows all things about markets and what to look for, what to avoid, and some red flags. So starting out, Grant Cardone, I believe, I'm sure a lot of people say this, but I remember Grant Cardone saying location, location, location. It's very important. I think having a good market is a great way. It's one of the biggest risk factors when you're looking at an investment opportunity. And so if you pick a good market, even if the economy takes a downturn and turn for the worst, your property it can still perform well if it's in a good market, right?
Yeah. So, I mean, in downturns, what we've seen in the past is rents don't necessarily continue to rise as they've been doing, but they don't necessarily dip. So you will at least still have the same amount of income. And as long as you can make your debt service and you're not losing, pretty much revenue, you can make your debt service, you're just cover your debt payments to the loan, and you can keep the property and pretty much just wait for the market to go back up, which typically, especially in multifamily, it does very quickly.
Absolutely. And I did some research. I wanted to kind of list some of the top markets in the country just so we can provide some context. And I'm sure there's a good chance some of you are living in these markets, and it helps to kind of have a visual of, oh, okay, well, I understand why this market's good. So starting out, Austin, Texas, I think we can understand why. I always hear about Austin, Texas on TV and just in real estate, of course, as a real estate investor, but more practically, I think certain places, it's in the mainstream, it's becoming more popular with young crowds. And so great market. Raleigh, Durham, obviously we live here, which is coincidence, but what is it? I don't know. It's a great market. We have a lot of hospitals here, big universities like Duke and UNC, just really strong anchors. There's Amazon's moving here, Apple's moving here. What are some other reasons that you would say?
It's Research Triangle. So, yes. There's a big, it's just a great location for jobs, and a lot of jobs seem to be coming to the Carolinas.
Jobs brings people, and people need somewhere to live, and so that's why people are.
Yeah, and people also bring money.
Yes, exactly. And so that's why real estate investors are finding a lot of opportunity here. And in general, I did want to dive. I know I mentioned this, but economic recessions, the economic cycle it consists of booms and busts. So when the economy takes a downturn and things don't go well, it's important to be invested in markets that are resilient to these economic changes. Kenneth, do you have anything that you'd like to why do you think the market is so important when it comes to being resilient and weathering the storm or weathering an economic storm?
Yeah. So, and the market has a lot to do with, the location market. If people are leaving, that means that you cannot push your rents, and that means that you might even have to drop your rents, because in order to be competitive, if there's less people, that means more supply, and more supply means less money. So it's just supply and demand. So typically in big markets, more jobs are moving there, like we said, and that means that more people are moving there. And with more people, that means that there needs to be more supply. And if everyone is trying to get the same apartment, that apartment is worth more, so you can charge more. Yeah,
100%. And so we actually invest in Atlanta, Georgia. Well, in general, Georgia and North Carolina, those are our main markets. We have some properties in Jacksonville, Florida, and a property in Texas. But in general, I think we can start off by just kind of touching on what attracted us to those markets and what makes them really great places to invest. I would say first off, there's a lot of, like Kenneth said, a lot of people moving there. I think that there's a trend. A lot of people are leaving large urban metros and they're moving to Sunbelt states or just southern states in general. There's a lot of reasons for that. They are maybe landlord friendly, so they're better places to invest. They might have lower taxes, so it's cheaper to live there. The cost of living is typically cheaper as well. And the weather, a lot of times people don't want to have to put up with the colder climate that they might find in a urban northern city, when they can just get nicer weather in a southern state and get similar benefits. And COVID and the impacts of COVID, from people having to leave their jobs and being able to work virtually, that gave them more lifestyle flexibility. So they're able to live in other places. And why would you live in a cold city when you can live in a nice place with a beach,
Yeah. And also, a $500,000 house in New York buys you like a little, like really tiny house.
Yes.
And then you can come to either, North Carolina, South, really majority of the South states, and for 500 grand, you can get a pretty nice house, honestly. So yeah, I mean, like your money just stretches more, and with people just being more virtual, they're working from home, they're starting to realize that, you know, like if I'm going to be working from home, I want to be more comfortable, you know, things like that. So
yeah, and my brother Jeffrey mentioned the other day. So now we want to dive into some of the benefits of looking at certain markets over others and what we look for in our markets that we invest in. Jeffrey mentioned, and I'm going to tie into this, but in Detroit, I believe it was heavily, a large percentage of the working population was very centralized in one industry. And so I believe it was the car industry. I might be wrong, but it was like car manufacturers. They left though, and that industry really tanked in that area. And as a result, a large percentage of the population there lost their jobs. And so that's why it's really important to not only find a place where a lot of jobs are coming, but make sure that it's a diversified industry, work industry. So there's not just one group. One employer, exactly. So if it's hospitals, great, but you want a little more diversity. And it might take some common sense as well, like to think how essential is that industry. So hospitals are typically not going to go out of work anytime soon. People are always going to need hospitals, but maybe they might not need car manufacturing or the oil industry. Things like that, they can change, whereas other things might be more resistant to change over time.
Yeah. And
so also looking in, and we mentioned this earlier, but looking at the major employers in the market, it's really important. Keep an eye on if obviously the name brands like Apple, Amazon, are these big organizations moving to these markets? You know, a lot of times you'll see this on the news headlines. It's big news, especially it's really good for the state because they know that it promotes economic growth and it brings higher income earners. And so they'll be spending money in these states, things like that. What are some other things you look for in a good market when it comes to maybe like cost of living or expenses in terms of anything?
Yeah, well, I mean, we like to see, of course, job growth, population growth. We like to see a decent medium household income, honestly. And yeah, I mean,
landlord-friendly states are also really important. I touched on this earlier, but landlord-friendly state, the difference between a landlord-friendly state and a resident-favored state is a state that if you're trying to evict a non-performing tenant, it might be easier to do it in one state than the other. And a lot of times the government, you can definitely look it up, figure out if they prefer or typically are to side with the tenant or the landlord. And this is important for different people. If you're a tenant, okay, you might prefer if it's a resident-friendly state, but as a landlord and as an investor, it's important to make sure you're investing in these states. And I think that is also a factor that a lot of in real estate investors specifically look to invest in other states, and that kind of growth, it makes it just friendly for you to invest in. Because if you're looking to invest in a state, you don't want to invest somewhere where it's going to take you months and months to take someone out of your property that isn't paying, because you're still responsible for the debt on the property and any other payments that you owe and any other debt that you have on it. So you want to make sure you're able to get them out as quickly as possible. In North Carolina, we actually evicted a tenant not that long ago. Can you kind of dive into that story just real quick?
Yeah, well, I mean, we of course had a tenant that unfortunately was not paying. I mean, he owed us 3 months rent, so almost $3,000.
And we were still paying the mortgage as well.
Yeah, I mean, that had to of course come out of our pocket, but we were fulfilling our end of the agreement, and he unfortunately was not.
Yeah.
Which, I mean, I understand, people go through things, but
we reached out multiple times. We even had a police officer go to the property and find him. He wasn't there. It was honestly, we were concerned, but we were ghosted by the tenant. So we had to take action. We moved to evict them. And Kenneth, do you remember how long it took from just general?
It took about 45 days. I mean, it didn't take that long. I hired an attorney, paid them to do it. They pretty much did all the paperwork. They went to court for us. Just documentation. So yeah, it didn't really take that long, but yeah.
Absolutely. So that's another factor, how landlord friendly is the state. If there's rent control in the state, like California has rent control is essentially when the government or the local policy is that you are only able to raise rents a certain percentage. So you're not able to, if the market supports higher rent growth than what legally you're allowed to do, then you really can't you can't add as much value as you potentially could. And so I believe Jacksonville, Florida was experiencing around 18% growth, but I believe there are some states where you can only increase by, let's say, just for example, if the state only allows you to increase rent by 8% or 10%, then you aren't that extra 8 to 10%. You're not allowed to push rents higher than that. So that really will impact your value add. It can impact your returns to your investors, and it just has a lot of negative impacts that you should be conscious of if you're looking to invest in a state.
Yeah, and 18% is 18% in the last 12 months. That's what Jacksonville did. And to put that into perspective, you know, if you were paying $1,000, you're now paying almost $1,200. So $1,180. So that usually we underwrite that for renovating a unit and pushing the rent after putting $7,000 into units. But it's just doing that organically. So rents are just going crazy. Yeah.
Yeah. And of course, you know, crime is another factor that we like to be aware of when we're looking to move into a market. And I think this is more sub-market specific because, of course, a state crime is going to vary throughout the state. So you want to look at the specific market. And I think that varies per property. So what should you look for when you're looking at a property or an area, like a little neighborhood, in terms of the crime, and what are some maybe red flags?
Yeah, well, I mean, you know, there can be crime literally in the best places. I mean, typically not, but
there could be like robberies, things like that.
Break-ins, robberies. But you know, we don't want to see crime like people getting shot or murders on the property just because.
And it happens. It's happened.
It does happen, even in the best of places, honestly.
Yeah.
But yeah, like that's a red flag, especially if it happens more than more than once in like 1 to 2 years. So if you see that it's happened in the past, I mean, there could be a story and it could have just been a one-off thing, but if it's consistently happening, that's definitely a red flag.
Yeah, and I believe particularly the lender doesn't like it when there's certain crime. The lender is your biggest investor in a property. So what are their concerns with crime? Is it similar to what you just said?
Well, I mean, no one wants, I mean, if someone dies on your property, that's a big liability. So, you know, insurance, you know, lawsuits, just all kinds of headache that the lender doesn't want to be a part of. We would not want to be a part of. And then of course, you know, someone dying is just, you know, just unfortunate. So,
and this is maybe, I mean, of course, if they die from natural causes, that's one thing, but like, I think you're referring mainly to like murder.
Yeah. Like someone getting shot, stabbed, kidnapped, like just really, I guess.
Are you speaking from experience of kidnap?
No.
I mean, dramatic. Okay.
People, but just crime in general, like things that are just violent crimes.
Yes, violent crimes. I think that's the key. Violent crimes. And of course, you can't avoid every crime. I mean, things like Kenneth said, bad things happen in good neighborhoods and bad neighborhoods. It's just important to be aware of what the history of that area is and maybe that property. And that way you can kind of have an understanding of maybe the people that might want to live in that property, the people that live around that property, and you can make an educated decision based on that information if you want to invest there and take that risk, right?
Yeah,
absolutely. So I also like to always touch on market anchors. Market anchors are different depending on where you are, but I would just speak for Raleigh, Durham, North Carolina, that area. We have universities, colleges, like the educational institutions and things like that. We also have hospitals, and the Raleigh is also a capital of the state, so that makes it a strong anchor as well.
Tech hubs,
yes,
just business,
large businesses.
Yeah, like large business.
These are things that are going to be strong if an economic downturn takes place. These are like colleges typically don't go out of business unless it's some small college, but most colleges will continue to have students. Students, you know, of course, are going to need somewhere to live, and they might actually end up working in that area. A lot of times, there's a lot of businesses that come to an area. Students might start businesses in that area. So just, you have to think of kind of outside the box too. But hospitals are another great example that I touched on earlier. People are always going to need access to medical care and attention. So that's obviously going to be very important. And it's actually a strong indicator that there's good jobs in that area. Those nurses and doctors, people are going to need a place to live. School zones are also a factor that you should take into account when you're looking at a market. A lot of times a good school zone is a place that people are going to want to move to and live in. So it'll be more desirable. Or if it's a bad school zone, or the schools aren't high performing schools, then that might be a good indication of maybe the types of people that are going to be living in the property, and also whether or not you're going to be able to attract the residents you want, or if people are just going to be wanting to live in that market in general. And maybe if you're wanting to tailor to families in your apartment or even your rental, if it's a single family house, then what kind of people are going to want to live in that property? As a parent, you take the school into account.
Definitely. Especially, with like the influx of people that are moving here.
Yeah.
They're definitely looking at what schools and like what areas have the best schools. And then they're looking for properties, whether they're buying or renting single family or apartments. They're looking for what areas have the best school districts.
And we mentioned that is because even during an economic downturn, people are still going to need to send their kids to school, So even if maybe they can't afford that rent anymore, someone is going to want to live in that school zone and want to have access to your rental, because you have to put the address if you want access to that public school. If it's public, if it's private, well, then chances are you're going to have a good tenant base anyway.
Yeah.
Because you have to pay for private school. Military is another strong anchor that we have. We have one in Fayetteville. It's a military base there.
We have a single family rental. Yeah.
We're talking about the military base in Fayetteville.
Oh, but yeah, there is one of the biggest military bases, I think, actually.
And the military is also, I would be very hesitant to that being the main employer in that area, because there has been instances in the past, not in our experience, but I've heard of other investors. The military base was moved, and it really impacted the economy there, because that was one of the biggest employers there, and it was an overwhelming percentage of the population there actually worked at or with that military base.
Yeah.
So,
I wouldn't say. I mean, I don't think you can't really just pick up a military base and move it. Obviously, so. But I think what he means is, like, when we go to war, all of the people that are literally living, like, if the population on your property is majority military, they legally are allowed to break the lease and stop paying you. So if you have 20% or more of people living on your property and one day all of them just leave, you're in big trouble.
Yeah, I mean, that's of course the worst case, but no one thought COVID would happen, and it happened. So you want to make sure you're kind of insulating yourself from that risk and that danger of that potentially happening, and what you're going to do if that happens. So it's good to have a military base in your market, but don't let it be the main employer or the overwhelming majority of the place people work. And so in general, Kenneth, do you think if you're looking to travel to, or if you're looking to invest in a market, should people travel to the market in person? Is that necessary? See it themselves?
I think, in order to at least start looking, I would say you don't have to, but eventually, especially if you're looking at properties at that point, you would want to see the market just in general, just drive it, get a feel. You can really tell how a market just feels by just driving it, some markets might seem like a little spread out and just a little bit more quiet. And then other markets are cities and things like that. So yeah, I would definitely say it would be important eventually before you buy a property to at least go there, but you don't necessarily have to. If you have boots on the ground that can do that for you, they can pretty much just kind of let you know, but at least know someone if it's not going to be you.
Yeah, absolutely. I would also say it's important to have boots on the ground, or if you can't be there yourself, because you want somebody that has access to the property if you need it, or if there's an emergency, someone needs to be able to access it. Also, fun, pro tip. I don't know if you guys probably already do this, but if you don't, visiting the property at night is something that might seem like common sense, but actually makes a lot of sense when you think about it, and maybe you didn't think of it. If visiting at the property at night, you can kind of tell what's the nightlife like in terms of, is there people on the streets? Are there people just walking around, or does it seem kind of quiet? Getting a sense of that would actually help when it comes to knowing what the market's like both during the day and night. And also, you can kind of put yourself in your own resident's shoes and see, okay, would I be comfortable living somewhere like this? Is this the type of people I might want to have living in these properties? Would the person I want to be living in these properties be happy in this kind of area? Things like that.
Do I feel safe? Is there enough lighting? Safe?
Yes, lighting. All small, might seem like small details, but it makes all the difference, especially in the appearance. Because what if a potential resident is driving past the property at night and doesn't like the area, or doesn't like the way it looks, or it looks kind of dingy if it's dark? Things like that, really small things, and we can really have a major impact on it.
Yeah.
And I like how you said you don't have to live in the market. I don't know if you mentioned that, but I think you did. You don't have to live in the market where you're going to be investing in, but we like to live in markets we like to invest in markets where we can actually travel to, and within reason. We don't want to have to take a 5-10 hour flight to visit the market, and that's just our personal preference. But Kenneth, can you kind of touch on maybe what are the benefits of living kind of in close proximity to the markets you're investing in?
Yeah, well, you could just travel to them. You can see properties that, are being sent to you. It's just closer. If something were to happen and you had to get up right now and get there. You can get there within, a few hour drive or maybe like a quick plane ride. But yeah.
Yeah. And I know that I believe I listened to this on a podcast the other day, and someone on the podcast said that real estate is local. So even if there's a national economic crisis, real estate, it really you have to kind of have a pulse on the specific market that you're investing in. So what happens in one market in North Carolina is going to be very different from what happens in the market in like California. It's going to be differences. And so I just kind of wanted to touch on what people mean when they say real estate is it's locally based.
Yeah, because I mean, in certain areas, I'm looking at deals that are 70,000 a unit, right? And in certain, they're pushing 200K a unit. So it's like, it's all based on where you are, and 100%. Every single unit, in some areas, labor might be a little bit more. In some areas, labor might be less. So you might get materials cheaper in some areas. You might get cheaper for more expensive. So it's all local, and not just that, but the rent growth, job growth, like all of that is local to that specific area. So
yes, and I'll just give you an example. Charlotte, North Carolina, I believe continued to experience strong growth throughout the pandemic, whereas California, the markets that were maybe more impacted because people were leaving, like California, they had much different experience than a market like Charlotte, where people were actually moving into. So just to kind of juxtapose those two markets and show there's a big difference between them, and it just really depends on the local market, because overall similar things were happening as a nation. We were all experiencing quarantine, and people all over the country were losing their jobs or leaving their jobs, things like that. So you really have to look at it on the kind of a micro economic level. And of course, macroeconomics is important, but when it comes to real estate, things really happen on the micro level, and that's why maybe what things happen on anything that happens to the nation might not really impact a market the same way. Two different markets the same way. If you guys have any questions about what to look for in a good market, maybe what some red flags are, or what reasons we like to invest in certain markets, and maybe what reasons we have to avoid other markets, let us know down in the comment section below. Also share what markets you like to invest in, and maybe if there's a market you will never invest in again, or you will never invest in, we would love to know what those are. So drop them down in the comment section below. If you got any value out of this episode, please share it, like, and subscribe to our channel. And if you want to find us, Kenneth, where can they do that?
You can find us at Donis Brothers on pretty much every single platform. So Instagram, Twitter, TikTok, YouTube. If you want to check us out, our 5 Mistakes Passive Investors Make Playbook, that's www.donisinvestmentgroup.com/playbook. Just some free education, no financial advice, but it might be a great resource for you if you're looking to invest at some point in real estate. Let us know if you have any questions, or if you want to just chat, DM us on social media. Yeah.
Thanks, guys, for your time. Hope you have a great rest of your day. Let's take action.
Take care.